Robert.
Well, dealing with
Robert,
it.
I watched the.
I'm dealing with my disaster.
What's your disaster?
The table pounding disaster?
Yeah, my table pounding disaster. Some days
if misery loves company, I'm with you. I'm in it.
And some days you're the bug, and today I'm a bug.
I'm in it. I'm with you.
How much your stock down?
30% today, down 60% in a month.
Oof. Yeah, that's proper disaster. That's proper disaster.
That stings. That stings.
All
right, let's retweet this stuff.
On a positive note, buddy, I saw the Philly 30 for 30, which I thought I enjoyed quite a bit. You ever see that before? They were talking about the Philly special on ESPN. They were talking about that first Super Bowl when Nick Foles brought it home for you guys.
Yep. Yeah, that was a
Philly.
That was an amazing play.
So Jen, I'm not seeing us live on social on Twitter. Are you?
It says we are.
It says we are.
Ben, are you seeing it? I can't. I got nothing to retweet.
Yeah, I see it.
Not that it matters.
Well, we got a viewer, so gotta be someone.
I think it's me. I think it's me.
Oh, all right. Let's do the show for one viewer.
We did that when we first started. I remember we get like one, it would be Steve. It was like very sad.
Yeah. Here, Steve, try what I just sent you. I think it's the same link.
All right. Yeah, I see that, but I don't see it in the feed, so I don't know how.
All right, let's rock and roll.
Maybe hit post this.
Post this. Playback speed quality.
No, click where it says share.
No. No. Let's try one more thing here.
Here,
Normally you see it, go to Wall Street Beats, you see it in the feed.
Right.
There it is. Okay, I see it now. Whatever you just did worked.
It just says we're live, so you don't have to do anything unless someone wants to reshare it.
Okay, that's what we want to do. All right, Ben, you can reshare it now. And same with you, Mr. Marston, if you're so inclined. So we can tell people we're here, because I know Mr. Marston has lots to talk about. His peeps are going to want to know he's here today.
Here, I'm sending it.
What's that?
I had to take that ticker off my Bloomberg today.
Just so you don't have to watch it?
One of those days.
Hey, look, I had that happen to me, Robert. See, this is why you know, when you play with the bull, you might get the horn with small caps, man. I mean, I remember Steve was in that Goodyear tire with me, and then I got James Hardy the next week when I was down in St. Bart's, and it was like two small caps, minus 25%, minus 30%, back to back. I was like, you know what? I'm not doing any more small caps. That's enough. I have no small cap for a lifetime with the 2 weeks. Man, those things can really hit you.
This is a little different, and it's a mistake. I've been bludgeoned, but it's very interesting situation. I'll get into it. I have 10 minutes to talk about what's not.
All right.
Rock and roll, buddy. Let's go.
Let's go. You guys ready? Let's do it. Welcome to Wall Street Beats, everybody. I'm Steve Lamar. Today is, what is today? Wednesday. It's ski week, February 18th. Welcome to the show. I've got our small cap and value, large cap value pro Robert Marston on with us today, who's got lots to talk about with a few table pounding longs. And Benjamin Bry, our macro pro, who's never short on something to talk about. So let's get it started here with Mr. Marston. What's on your mind this morning besides this?
Well, gentlemen, I have a saying.
Go for it.
Some days you're the windshield and some days you're the bug. And today I was the bug.
Today you're the bug. Right.
So, yes, being a contrarian is not without its difficult periods. And with one of my stocks, a former table pounding buy company called SimilarWeb, it is pounding me under the table. It's been that challenging. Okay. So, the stock was 17 last year. They sell data, digital data gathered from all around the world. And, it's they sell it as a service. And the stock, when the stock went down 50%, it hit my buy screen. It's too cheap. And I bought some stock, talked to the company, lots of research, including experts and users and analysts in the company, and decided to make it, for me, a normal, a large position for a speculative Israeli company, because that's what it is. And not only is it a speculative illiquid company, but it has what's perceived by the market to be existential risk from AI. And with that, there's no valuation level that's making it safe. So I started buying it at 8. I bought it down to the 4, and today it's down 30% after a few percent earnings miss and sales miss, and a few percent guide down for this year. So to frame it, I've bought deep value contrarian software stock my entire life, starting with Lotus Notes that IBM bought out. And the rule of thumb was, since they generally trade at 5 to 10 times sales, you buy them at 2 or under 2 times sales. And every time I bought a stock under 2 times EV to sales in software, I've doubled my money at a minimum. And when this stock hit that $8 range, it was 1.5 times EV to sales. So I thought that was the beginning, and I started to accumulate it. And with all the research I did, I bought it up to a few percent position, which for a very small speculative stock is a large size position for that category for my long portfolio. So they announced news yesterday, and it has destroyed the stock. It has been interpreted as disastrous. And while in my contention, it's disappointing and not disastrous. So they have 81%. They ended the quarter with record sales, record gross profits, record cash and no debt, record backlog up 17% from the prior year, record percentage of multi-year contracts for their customers, 60%. And they claimed 2 very large LLM customer deals slipped into Q1 from Q4 and was responsible for the miss. So the company, to be conservative, they argue, lowered their revenue guidance outlook for the year. Well, lowered it, initiated it at 10% revenue growth. And 10% is disappointing. It was supposed to be 13 in my book, accelerating to 15. So that's not insignificant. But at today's price, the stock is 0.6 EV to sales.
Wow.
It's pushing nearly half of revenues. Now, they had a competitor, SEMrush, that's being bought out now. They're in the process of getting approval to be bought out at 300% of sales. So that's the difference here. The market has gone from treating this news as a slight disappointment to a company that's doomed to go bankrupt. Could that happen? Absolutely. I've always said that there is existential risk that AI obsoletes this company's business model. If you're in the software business, you could argue that Salesforce business model is obsolete too, right? You could argue that Workday's business model is obsolete. You could argue that eventually Microsoft's business model and software might be obsoleted. I don't know. There's this massive unknown hole that one could argue that every software company is going to fall into. It's just when, not if, as AI coding and software creation gets extremely fast and extremely free. So that's what the stock market is saying is going to happen here. I don't know that. And when you buy Contrarian, you have to pay for the worst case not happening. I rarely buy stocks where the worst case is doom. A bad idea for me is typically something like, Ceragon, where they missed their number by 20% for the year and I broke even. I'm breaking even on the stock. That's a typical flub when you buy things down and cheap. And if you're aware that the business is going to implode, you tend to figure it out before the market figures it out and get out, with a small loss or a break-even level. But in this instance, the market went straight from, disappointed to doomed, and a $310 million business with 80% gross margins, still growing 10%. You know how many companies in the world, in the U.S. stock market, grow 10% organically? If I did a search of the S&P 500, my guess is it's probably less than 20%, I would say. So they're still a pretty good company, and they're still growing. And
so what do you do? What do you do with this thing here down 30% this morning, Robert? It sounds like it's already a decent sized position for you. Do you press it?
I have.
Sounds like you still like it.
I like it. It's always been a contingent buy, right? If AI doesn't put them out of business, my expected return on this is $1 to $25 over 5 years. Okay, it's hard to make. It's hard. They have $1 in net cash and no debt. Okay, so it's hard to even say that they could go to $1. So I've limited my capital, and I always, to prevent myself from averaging down in a bad situation, I limit the dollars I invest in every category. And my limit was hit. My limit was hit at 4. So I don't have any room for 2. Now, if it goes to 1 or 1.5, would I violate my limit? Probably. If I didn't own the stock, I would definitely initiate a lottery ticket size position today, because again, these guys have 11% of their business is AI related. It was low single digits here. They have 4 AI products, and they're starting to sell their data to all the large language model companies out there. So and they're integrated. They announced today they're going to be integrated with ChatGPT. They're already integrated with Claude. They're have a revenue share with an AI Manus, MANU. I think it's Manus that Facebook owns. An LLM. Yep. So they're working hard to get their their AI exposure to be a positive and not a risk. So we'll see how things. The only way they could, I can't prove that they're not doomed. Is anybody can say, well, they're doomed, and they're doomed. So there's no price you want to buy this, and that could be the case. No one knows here. There's so much.
No one knows.
So much rapid.
So this is a lottery. This is a lottery ticket buy now, and my bet is if this was in Ben's portfolio, he'd have been stopped out this morning. Just get me the fuck out and let's move on to the next one. Given the stock's down 30%, and I'll bet that's how most people are treating this morning.
Yeah, absolutely. And if I'm down 60%. So if it might not hurt to sell the stock, wait 30 days and buy it back, because you just don't want to look at down 60% positions. It annoys the shit out of you, right?
You know what they say though. There's always 100% more. So
right. More. So it won't be with no debt. There's no financial risk. There's no leverage risk. The business theoretically grows, and they're still growing. But again, is the decline, the expected growth rate for one calendar year from 13% or 13% to 10% off a smaller base, because they missed by a few million. The estimate for revenues versus 282 this year was 323, and they announced the midpoint at 310. So it's a $13 million miss, which, is still, mid-single digits, which is not great. But is it worth a stock to be down 80% from its 5-year high with net cash, with cash flow positivity, It's cash flow positive, 8 straight quarters. So if you were buying this as a business, you just have to, if they grow 5% a year, the stock will triple. So it's just, they just have not to be, they have to survive AI because the stock market is pricing this as though it's on its way to bankruptcy. That's what the stock market is pricing.
Well, it sounds like they got enough cash to kind of reinvent themselves along the way here too. If they start to see that happening, they can pivot.
They could
pivot.
pivot.
They're not already in the process of doing so. What's that?
So they could be like GameStop, just reinvent yourself with the cash you got.
Exactly. Get into Bitcoin or go buy a gold mine or whatever it is that GameStop does these days.
Again,
all right, Ben, what are you looking at this morning with the stock market ripping here on a Wednesday? What's that all about? No fears.
No, it's funny. Yesterday I was looking at the markets and we were at the breaking line, like in almost all the markets. Like the 10-year was at 401, the 2-year was at 338. Microsoft, some of these charts, they were just ready to go. Silver was 72. Credit spreads were up, et cetera, et cetera. And it was funny because I was looking at like 10:30 or something like that. I was telling one of my partners, I was like, I think it's gonna hold. It looks like it's gonna hold, and it held. And then vol went down 10%. And one thing I did, I swapped out of my H7s, SOFR H7s into Z7s last week. And I basically picked up 12 and a half basis points. It was like 96.85 versus 96.73. So when you get 9 more months and 12 basis points, seemed good. That actually is compressed 6 or 7 basis points, which, when you trade a spread on a forward curve, you can get independent of what the curve moves. Yeah, pretty good. I'm done with the NVIDIA. I tried that. I decided that was enough. You know what? I didn't make any money. I didn't lose any money. I've been involved with this AI company, and I'm now convinced that the architecture is going to improve so much, and there's going to be so much compression that the token, there's going to be a compute surplus on the horizon. Now, these guys will have a good quarter or two, whatever. But here's what I'd say: in a bull market, when you spend a bunch of CapEx,
Apple would agree with you on that, Ben.
Apple is amazing.
Not buying into this CapEx.
Those guys are going to come out of this thing with a new CEO. They didn't blow a bunch of money. Someone's going to go belly up, and they're like, you know what? Bring it in. We'll take a year off of buybacks. We'll just bring it in.
We'll take it on the cheap. Exactly.
Thanks for doing all that work. We'll buy your capital at 25 cents on the dollar. You know what? Maybe we'll buy a little similar web just to tickle Robert a little bit. And that's a joke, buddy. I'm sorry. Maybe a little too early. And so
he needs all the love he can get this morning.
I should sell
in a bull market
just to jinx it positively.
Okay. In a bull market, when you spend capital, the market rewards you. And all you have to do is go back to last September, where Robert would ping me every day and be like, look at this shit. It's just unbelievable. Oracle's putting a flyer out and getting trillion, a couple $100 billion of market cap. Well, those days are behind us. And because the idea is you put more capital to work, you get higher return on capital, blah, blah, blah. Well, in a bear market, it's the opposite, where when you start spending capital and the market doesn't like it, they start punishing you. So you're seeing that. You saw Amazon and Microsoft's earnings, they dropped them by like 10%. Meta in the fall got dropped for the extra spending. So I think if the market is going to punish these guys, they're going to be aware of it. Buybacks are going down. Hard for retaining employees and recruiting employees. There's going to be a point where, remember, these guys are just stewards of their stock price, that they're going to have to say, you know what, we're going to pause this a little bit. And then I'm telling you, as someone who's on the front line with this AI company I'm involved with, it doesn't take long to realize that the architecture of compute and the efficiency of stuff is going to improve and improve and improve, just the same way it did in the .com. And so you could have a compute surplus. And I'm not there yet, But I mean, I do have an EWY risk reversal, but I'm not going to tell people to do that yet. But we're going to get close, because the moment these guys pause or take a breath, these things are going to get dropped like similar web. You know what I mean? Like just absolutely 30% down that day. And I'm talking about the EWY, which is the ETF for the Kospi, the Korean market. You're talking about SanDisk. You're talking about Seagate. You're talking about Micron and NVIDIA, SMH, all that stuff. The Powell Industries that Robert and I looked at and stupidly didn't buy, Vertiv, all that stuff that's in the, right in the face of the fire hose of CapEx. There's so many people hiding in there, especially with the SaaSapocalypse thing. SaaSapocalypse, is that what we're going with? Or SaaSACRE? It could have been SaaSACRE too.
I think SaaSACRE is good.
I like SaaSACRE because I've been SaaSACRE.
Okay, the SaaSACRE has a lot of guys having to hide somewhere. So I think one of the places they're hiding is all this stuff that's like, hey, at least I know earnings are good right now. And so I think there's a crowded, just the EWI is up like 35% year to date so far. And early in the year, small caps and everything was going really well. We've obviously given some of that back, but the Kospi is not. The Kospi stands alone. It's like going to be the next silver, in my opinion. Which, by the way, I did catch that short.
So you punted your NVIDIA long, or did you get short semis, or did you get short anything?
Yeah, I have a short on the SMH. I have a short on the SMH, not a big one, but I was like basically thinking, I was like, I'll start putting this on here, and then I have the EWY. So who knows? It could be a little bit early, but it feels like I can just see one of these things where like the guy's spending all this money. If they're negatively incentivized to do this, and I'm on the front line seeing like, hey, the token compression from just, not going from step one every time that you go on an LLM, right? Like you use context and memory to improve the process. We as humans don't start at step one every time. We started like step 7, like when Robert and I look at a stock, it's not like we did when we were young bucks who were young analysts and, went through everything and it was just arduous, like, you could skip some steps. And so I think that will be coming for the LLMs. And then that will then follow through with less token demand and then better models, less need for GPUs. The memory thing also, like, let's be real, man. SK Hynix basically has been refinanced 3 times in the last 20 years, okay? And I remember buying Micron in 2016 for like $9 when there was no DRAM left because it's a commodity. They're having a moment, but just so does lumber. So does, lithium. Like these things happen in commodity markets. Like silver just had one. But don't confuse that for like the new NVIDIA or something. You know what I mean? So
what do you think?
What
What do you think, Robert? Is this just overhyped and people are hiding in these big name semis because of the SaaSapocalypse, as you guys like to call it?
SaaSACRE. SaaSACRE.
SaaSACRE, sorry.
Yeah.
I agree with Ben. I think you don't need as these things get smarter, software is going to make all this CapEx way more efficient as time goes on, and you're just not going to need as much of this stuff.
I think I think that's a risk. That's an intermediate term risk. The short term risk is everybody is now finally starting to acknowledge that there's massive delays in deployments, data center from infrastructure, delays and restrictions. And I think the big 5 hyperscalers have warehoused so many GPUs that there's going to be an air pocket in GPU orders and GPU sales. And I would be surprised if that doesn't happen, in a few quarters. Really surprised.
You're saying just because they can't get these things built fast enough because all the other parts required.
And Ben's buddy talked about the power problems on one of your shows, and you sent it to me and I watched it, and there's massive. I had a buddy of mine came over for the Super Bowl. He's a nuclear engineer at 3 Mile Island. And he said, Robert, we're way behind refurbishing this, bringing this plant up. We can't find people to splice copper wires. He said, we can't find electricians to do basic electrical, installations, and putting us way behind schedule. So if you think you're a hyperscaler and you can overpay your way to being on time and on budget, even with a
No
with
way.
a
No way. No way.
your whole life you've been able to buy your way to the front of the line. Okay, because you have the money, you can't buy your way to the front of the line because you can, but that doesn't matter. There's nobody at the front of the line to service. You're in
the restaurant and there's no chef.
There's nobody to take your order.
The point here is right, and it is actually something. If people are interested, they should go watch my podcast, Betting the Squirrel. We had my buddy Tom Jens on, which he's talking about, and he trades physical power, and he doesn't bullshit. He just runs by every constraint there is: transformers, human capital, interconnect queues. There's lots of stuff that people don't think about when you're just a tourist. And really, the only incremental supply there is in power is solar, and you know that because you just saw Amazon buy this big solar field out in Washington from a bankrupt solar provider, and the utility was like, they outpaid us. So they did outbuy in that case, Robert, but there's just not enough supply to come online, and so it's just going to fall short. And so I'm just surprised that they don't just think about it the opposite way, which is let's figure out how to make everything more efficient rather than let's just spend. And by the way, this is deflationary, and so there's going to be a point where this return might not be there. So yeah, I just think that if you think about what a year from now, what will be a lot lower, and I think it's all these things that are in the fire hose, basically. I think they'll disappoint, but both for Robert's point and for my point. And right now, because of the SaaSACRE, I think that's what we should call the title is what's the fallout of the SaaSACRE or something like that. And basically, because Robert's stock is a SaaSACRE also. He's a mini SaaSACRE. And
so look, I have a saying, right? The market is, I'd say, similar way. The SaaS numbers have been disappointing, right? The market has gone to doomed. And here's what you have to remember. Doomed always starts with disappointment. So it's not distinguishing.
All right.
Yeah.
So,
well, that's a good line. We should end with that. That was pretty good.
Fallout of the SaaSACRE is SMH and all peripheral participants.
Now, to be fair, I did talk about this a year ago on the show when Klarna turned off CRM because they used AI to create their own thing. And I have been adamant against buying SaaS software companies since then. I bought SimilarWeb because it was, 1/3 the price to sales ratio with the same business model and margins. And, because it sold data, and I thought data was going to be more immune than platforms that are being bought. So I was, clearly wrong there.
What about, so let's talk about
wrong every once in a while.
Well,
can we talk about the SaaSACRE for a second? So do you see any opportunities here in SaaSACRE land?
Again, I'm a contrarian. I wouldn't touch a conventional.
You wouldn't touch any of them. Okay.
And I've been saying that for a year or so.
Look, here's the deal on that. There's some of these are going to be fine. Anything that has a liability side to it, they're not going to rebuild it, okay? So like a Workday, for example, like anything that has risk, insurance, risk systems, HR, that stuff's underlying it's a wrapper on a foundation, basically, right? So if you're a wrapper on a workflow, yeah, you're effed, like a Zendesk or something like that. But if you're a wrapper on something that's really hard, I think but here's what I think the real issue is the terminal value. These things always just traded with ridiculous multiples, and they have 75-80% gross margins. Well, there'll be a question of will margins come down? Probably, and then what should the terminal value be? So I think we're having a terminal value re-rating because there's just a lot of uncertainty. Sometimes that happens, and it throws the baby with the bathwater out, which the SaaSACRE clearly is one of those things. Because it is a red sea out there in that world. But yeah, I think that if you're willing to do the work, but I think it's one of those things where you got to call the company, you got to really dig in, and you got to say, okay, how much cash flow are they going to make in the next 5 years? what percentage of the MV that I'm paying. Like, you gotta do some work. Like, I think it's not a tourist land. I think because some of them are gonna get smoked. I do think you could get a bounce. Like, I think there's a guy shorting it, and it's like, but that's just a trade, right? Like, you get a short covering type of thing in the IGV, but like that's I'm not going to recommend to do that on here. But I'm just saying that there's. Go ahead.
I want to fill in my comments. So the valuations are still well above what I normally pay on my distressed price to sales ratio. So if you're going from 10 times sales to 5 or 6, I'm not interested. If you're going from 8 to 3 or 4, I'm interested. I was only interested because we have an 81% gross margin company growing double digits that was trading at 1.5 times sales. Never in my mind would I see how it can go to 0.6, but it did. Okay. But the switching cost for the SaaS companies that are too high, that's where the value now lies. And like Ben said, there's too much data, proprietary enterprise data in all these systems, and they won't turn them off until they could do it very confidently and very painlessly, and they're not there yet. So there could be a trade, and they Workday and ServiceNow and Salesforce, they could all keep their status with slightly lower growth or slightly lower margins and be reasonably priced stocks. They're just not compellingly cheap, and the risk is still too high for me. So I'm not going there.
Staying away. You're not buying them. Okay.
Yeah.
I have my
smart.
Yeah, I think that's right.
I think that's smart. A lot more downside possible when these things get more fairly valued.
Yeah, I just think that's it. It's a multiple thing. Like right now, I don't think the market's saying, "Oh, your business is over." I think it's just saying, "Hey, we're re-rating you because we don't have any confidence on the sustainability of that cash flow into the out years." And again, what's that Scott McNeely or whatever the Sun Microsystems guy, like his quote about 10 times sales, and it's a ridiculous thing. 10 times sales, ridiculous. It's a ridiculous concept. Unless you're absolutely ripping growing, like 10 times sales is an absurd concept. 5 times sales is pretty damn expensive.
This is a very easy concept. You take the price to sales ratio and you divide it by an assumed net profit margin. That's your PE. So at 5 or 10 times sales, if you get a 20% profit margin, you're talking about 40, 50 times earnings. And most companies are not worth 40 or 50 times. We throw around price to sales ratios like they're nothing, but they really are. We're in the 99th percentile of price to sales ratios for the stock market. Crazy.
You know what is worth 40 times apparently? Walmart and Costco. That is just like unbelievable. All right, let's go.
Let's wrap it up.
Throw that out there.
You want to call it? Anything else you want to cover, Robert?
I'm good.
Nope.
You good? Ben, you good?
Let's send Robert an ice pack for his butt.
I'm less good than I was yesterday or 2 weeks ago, but I'm still good.
All right, good. And Ben, where can we watch that Benny and the Squirrel episode you mentioned? Where do people find that?
Oh yeah, that's on my channel on YouTube. On my YouTube channel, you can go. All right, I love it. Go to Benny and the Squirrel on YouTube and look up Tom Jens. There's an episode about the hard truth of AI power. And it's really good. Now, look, Tom's a little dry, so you're gonna have to hang with him. But like, he's really smart, and he gives
Just put it on 1.4 speed or 1.25 speed. Yeah.
Yeah.
That'll help you get through it faster.
Exactly.
But you get the content.
Exactly.
All right, boys. Let's wrap it up.
The content's good.
Us on Wall Street Beats. Follow us here tomorrow. I'll be your host again with I'm not sure who's on, but it'll be a good show. wallstreetbeats.com, and let's call it. Have a great day.
All right. Later, guys.
Here's my shameless plug, Ben.
There you go. Yeah, there's your Einstein hat.
There you go.
I lost my gray one, Steve. I'm pissed. I can't.